Now, if you notice on your screen, there's a little area that says handouts. I've put together two brilliant handouts for you. One is the Introduction to Technical Analysis from investing.com. This is an incredible resource guide. It's not a little ebook. It's a very long resource and research piece of information, a research education tool. Please click the download button down. There's nothing you have to sign up for, nothing you have to pay, nothing you have to do. Just download it to your computer and read it and use it as you need be. I've also put together for you the strategy that we're going to be discussing today, a trend following strategy, so that you can refresh yourself after the class is over. But please click the download buttons and download these files. They're just PDF files because they're only available during the live class. There's no other way to get them. Now today in class, I'm going to use the term security. I might also say the euro, I might say Facebook, I might say Google, I might say, let's see, Bitcoin. But in general, I'm talking about all publicly traded financial instruments in which a market exists. I'm also going to intermix the terms investing and trading. We know the difference, and we're here because Alvexo sponsored the class, and we're mostly traders. Some of us might be investors. But the concepts we talk about are today more specific to traders than they are to long-term investors. But the knowledge and the concepts and the techniques are great for everybody. Now, ultimately, whether I'm giving a webinar, whether I'm giving a seminar, whether I'm doing a public address at a conference, whether I'm meeting traders one-on-one, no matter what I'm doing, it seems like everybody asks me the same questions. I could almost hold up little flashcards. What should I buy today? What should I sell today? What will price of gold be later today? Do you think Bitcoin's going to go up to 10,000? Do you think gold's going to drop to 1,200? Do you think the euro's going to be trading back over 113? Well, everybody wants to know what will the prices be tomorrow, next week, or next year. Now, wouldn't investing and trading be easy if we knew the answers to these seemingly simple questions? But I don't have a crystal ball, and I don't have a Ouija board, and neither does anybody else. So if you're attending this class in the hopes that technical analysis and trend trading strategies has an answer to these questions, I'm afraid I have to disappoint you early. It doesn't. However, if you're attending this webinar with the hopes that this technical analysis and the trend trading strategy will improve your investing and trading, that I have good news for you. It surely will. But again, like I said, ultimately, it's risk management and money management. Now, today we're going to be discussing how to trade with the trend and a strategy in which to do it. But first, we have to kind of understand the concept of trend following. Now, uptrends and downtrends are created by crowd behavior, and they exist for all instruments in all time frames. Now, trend following is perhaps the most popular long-term strategy in all financial markets. As a trading strategy, it is exceedingly effective and profitable when the conditions are favorable. It's quite straightforward in its methodology, and there are many individuals, past and present, famous and obscure, who have used this strategy to reach successes and profits. We should note that the technical aspect of trend following is in fact quite simple, but also that it requires, before everything else, discipline, sound money management, and a patience from a trader. Trend following is not a short-term method, and patience and determination are important as correct analysis as a result. Now, my philosophy or my belief is that the markets are random because the markets are all about price. Price is all controlled by human beings, and the human psychology behind the pricing is based on what one trader is willing to buy something for and what one trader is willing to sell it for. And because it's all based on human psychology, price of an asset, which is the only factor that counts, is completely random. It's all over the place. But there are certain times in which price exhibits non-random behavior. This non-random behavior is found when price is trending up or trending down. Now, one has to first understand what trending up or trending down is, because price can be moving up without trending up. Price can be moving down without trending down. Price can be falling, but it can be falling in an absolute random, haphazard way. And price could be climbing in a random, price could be, Bitcoin could be at 8,600 and jump instantly to 8,900 and come back down to 8,650 and go up to 8,950. That's not an uptrend. That is volatility and just moves in the market. Okay. An uptrend is specifically defined. Okay. And we're not talking about a trend line. We're talking about an uptrend. Okay. An uptrend is defined of higher highs and higher lows, meaning a trending market is a market that is push and ease, push and ease, push and ease, push and ease. And the more developed these pushes and eases are, the more high probability trades you're going to get out of it, because then they are becoming very non-random. So the market has to push up to make a higher high. Then the market's going to ease down. Markets always ease back down. It's going to make a lower high. It's going to make a higher low than the previous low. It's then going to, once again, at some point, push back up to achieve a higher high. And then it's going to ease down again. But this point which it eases down to again will be higher than the previous low. And each step up this ladder is going to consist of, some people define them as waves, some people call them cycles. Okay. But they're just peaks and valleys. And the more well-defined this series of steps up the ladder is, the better trading you're going to get. So to apply this strategy, we must first be aware of the existence of a trend. Without identifying a trend, we would be gambling. And that's not the purpose of trading. Both fundamental and technical analysis can be employed for identifying a trend. And both of them have their advantages and disadvantages. It is, in general, a good idea to use a combination of them to decide on the trend's character and deciding our entry and exit points. Now, a market that is moving upward, you can use, say, a moving average. And a moving average, as long as price is above the moving average, it is said to be trending up. But that's not telling you it's trading in a non-random fashion. You need the markets to present that non-random movement. So that is a well-defined trend. That's why you have to sit back. You can watch a zillion assets. You have to wait till you have this specific trend pattern. Okay, now the fact is, these happen all the time. They can happen over an hour of trading. They can happen over 2 days of trade. They can be a long-term or a short-term. But general observation of a market swing points is the first point of call in determining if the market is trending. If you do not see a pattern of higher highs and higher lows, or lower highs and lower lows, but instead you see sideways price movement with no obvious general up or down direction to it, then you are probably looking at a range-bound market, or one that's simply chopping back and forth. So let's go over and look at a live chart for a quick second. Now, this is my standard trading chart, standard teaching chart. This is the Euro US dollar 60-minute chart. I have not picked it for today's class for any reason. I always teach from this chart. Now, if we see here, we would say this market is trending up. And look at this, push and ease, push and ease, push and ease, push and ease. Each time it is obtaining a higher high and maintaining a higher low. Okay. Now we went into this stuff here. Okay, we went into this stuff here. Now, even though through all of this price fell, we didn't really have a trending market. See the difference between the two? You couldn't use a trend trading strategy to trade this mess. We could have used one to trade the up movement, but not the down movement. Because here again, prices fell. Okay. You could say price fell in a downtrend. Okay. If we were to move on here, a 20 period moving average, okay. The rule of moving averages, when price is above the moving averages, the market is trending up. When price is below the moving average, it is trending down. So we can see all of this movement is below the moving average, but we still had nothing developed that we could use in this strategy to make any decision. So, like I said, the first thing we want to do is observe. We want to find assets that are forming this well-developed uptrend or downtrend. So you shouldn't have to think too hard about whether a market is trending up or not. Most traders make trend discovery way too difficult. If you take a common sense and patient approach, it's usually fairly obvious if the market is trending or not, just by looking at the raw price action on a chart from left to right to make sure that the swing points on your chart. But really, I just use my eyeballs. Okay? If I can't see a distinct uptrend or downtrend that is making these higher highs and higher lows, that's giving me this, well, I just move on. I can't see it. I don't need to go any farther. I mean, I can apply other strategies, do other things, but not here. Now, if you first choose whether you want to employ technical or fundamental analysis for your method, or a combination of both, when I'm looking at a chart, everything I do on a chart is classified as chart analysis or technical analysis. I always want to be aware of the fundamentals, but I'm not going to carry the fundamentals over onto my chart, because fundamentals are more about economic events, return on investment, profit and loss from an investment from a public company, political events. They will drive the market, but they're not going to necessarily define an uptrend or downtrend. Like a couple of weeks ago, when our buddy Mr. Trump killed the general from Iran, all the markets went running to risk-off trading. Okay. In risk-off trading, we saw a lot of the safe haven assets jumping up, soaring up, but it didn't give us an uptrend that we could trade. It gave us a panic. It gave us almost a soaring market. So technical analysis can suggest the beginnings of a trend, but it's unlikely to tell you much about the length or the strength of the same. Thus, I suggest that you use both technical and fundamental for your trend following strategy. Now, how do I decide on the existence of a trend? There are many technical tools that can signal the phenomena, but there are an equal number of false signals generated by them. Remember that there are only three kinds of trends that can exist: flat, up, or down. And it is possible to speak of trends between any 2 points on a price chart. Simply take two random points on a chart, draw a moving average on them, and the pattern that arises can be analyzed as a trend. And this is what I keep reiterating to you. We can have a billion weak trends, long trends, crazy trends, uptrends, downtrends. We need to see a well-developed uptrend or downtrend, making higher highs and higher lows. That's the only one we can use for the strategy we're going to look at. There's tons of other strategies you can use, but this is one strategy that is simply for well-defined trends. So as you see on the chart here on the right, this is in the downtrend. We're making lower highs and lower lows, lower highs, lower lows, lower highs. And I don't need to draw anything on it. We can see it with our eye. So if the trend can be identified visually, why use technical analysis tools? Even though we can notice the existence of trend, we still need the technical tools to trade it and to time it. Trending markets tend to make strong moves in the direction of the trend, followed by periods of consolidation or counter trend retraces before the next leg. So you need to learn to identify the different parts of a trend. This will help you avoid over trading during the chopping and consolidation periods and will give you a better chance of profiting when the trend makes strong moves. So here I'm going to share with you a presentation that'll help you unfold this strategy once you see the trend, and then we're going to go through it step by step. And here we're going to use one other tool, and that's Fibonacci numbers or Fibonacci retracement tool.
In this situation that we see, forgive my terrible drawing of these candles, but we see that the market came up, retraced down to this swing low, and then we broke above the most previous structure level here. And since we broke above and closed above this most previous resistance level, our expectation would be a continuation of bullish momentum, a continuation to the upside before a break below the most previous swing low right here. So what we expect this market to do is to go up further before it comes down and breaks below this most previous swing low. And the way we take advantage of this using this trading strategy is after we get a break above, close above the most previous resistance level right here. After we get a break above, close above this level, we take a Fibonacci retracement from our swing low right here up to the highest swing high before the market starts to retrace. And all we do is wait for a 786 retracement. As I said before, very, very simple, yet very, very effective strategy. The reason we wait for this 786 retracement is because we expect the market to continue bullish before breaking below this swing low. So what that means is if we wait for a 786 retracement, we can put our targets back up at previous structure because we expect the continuation of the bullish trend, and we can put stops down here below the most previous swing low just in case we're wrong, because if we are, we want to get out for minimum losses if we're wrong, and we have an opportunity for a very nice gain. And I hope that makes sense. If it doesn't, then leave me a comment and ask any questions you might have, and I'll try to answer them best I can in the comment section below this video. I'm going to now go to the charts and show you a few examples on the dollar yen that we took advantage of over the past couple of weeks. And then I will show you a live example of this trading strategy on the Euro Aussie 15-minute chart. Alright, so here we are on the dollar yen, and I'm just going to start right here in a random position on the chart and show you a few examples of the trend continuation 786 strategy. So what we look for first is a break above, close above, or break below, close below of a previous structure level. Here is our previous resistance level. We obviously break above and close above it right here. Since we broke above and closed above that level, what I would do is, if this market had not already played out, if this was all to the left and I had no right into my chart, what I would do in this situation is take a Fibonacci retracement from swing low to swing high and wait for the 786 retracement right here. And as we can see, the market rallied before ever getting close to the 786, which is fine. That will happen a lot. And next off, let's continue on the chart.
Okay, now remember, we discussed you can have other strategies to make determinations. In this trend trading strategy, we're going to be using that Fib 786 as our trigger to make this trade because this is one specific strategy. Now, if we think about our retracements and our higher highs and higher lows, or our lower lows and lower highs, the 786 is the lowest point well, 100% means it would dip all the way down to where it started. 786 is the lowest point using a Fibonacci retracement tool that we could expect that asset to bounce back up. Okay, 50%, there's a good chance. At 38.6, there's a very, very good chance, but those are hard to play. Okay, those are gambles because it could go all the way down to 786. If we're in an uptrend and it retraces and comes all the way down to 786, that is the strongest point in which we should enter the market. Okay, because a 50% retracement doesn't mean it's going to continue to bounce up over there. So there are other strategies in play. We're waiting for a defined trend, a Fibonacci tool, and then our 786 retracement on that tool. And I'll show you in a minute on the live charts how to actually put that fib on your chart very quickly. So let's go back and watch the end of this.
As you can see, we get another break above, close above this previous resistance level right here. On this candle, we break above, close above this level. So what I would do is take a Fibonacci retracement from this swing low, the most previous swing low here, up to the swing high before we start to really retrace. And as you can see, we came down here to the 786, would have been filled on this order, and we would have hit targets there, coming up to this previous resistance level, which is where our targets would have been, and our stops would have been below our most previous swing low. This would have came down and put us through a little bit of pain on this wick right here, but we would not have got stopped out on that trade. And we just continue down the charts doing the same thing right here, break above, close above this level. So now we're looking at this most previous swing low right here. So we come from this swing low up to the swing high before it starts to retrace. We would have bought the 786 right here on this candle wick, and we would have been stopped.
See, again, this is a perfect example. It doesn't always bounce. Okay, what you want to do is minimize your loss, but wait till it gets at 786. It can continue going down. Okay, it can go down to a 100, which means it's equal to the start of the trend up, or it can break through and just come all the way down. Okay, but the odds are, statistically, the odds are it will bounce off the 786. But by placing your stop loss correctly, you don't mind if you have the breakthrough and the lost trade, because you've gotten out of it early enough that you haven't been hurt too bad.
Trade. But look here, look what happens now. Now we have, instead of breaking again to the upside, now we have broke through this support level, and this support level. What that tells me is bearish rotation. Now that we've broke down below these support levels, I'm in a bearish trend mindset. With that being the case, I'm going to now take a Fibonacci retracement from.
Now, those bearish support levels come from the lower lows each time it made a peak and ease, push and an ease. So if you notice, each one of those support levels is the lower low in the climb of the previous uptrend.
This swing high down to the swing low, and look for my same 786 retracement. As you can see, would have been filled here, and this is a trade we actually took advantage of. We were filled there, and the market eventually rolled over and did hit targets. So I hope that helps you to better understand the 786 strategy. As I said before, leave me a comment if there's something you don't get about this strategy, and I'll try my best to.
Okay, so now we've got some general ideas. Okay, but we have to do a little bit more than some general ideas. We don't want to risk our money and trade just on some quick examples and a pre-recorded presentation. So one of the first and most important things you have to master is market timing. Okay, because market timing never works when one is trying to predict reversal points on a technical basis. However, market timing in the context of a trend with the purpose of picking the counter trend extremes and using them to enter a trade is necessary and profitable. And there lies the main principle of trend following strategy. Recognize the trend, identify the counter trend moves, and use them to enter a trade in the direction of the trend. So the 786 is the counter trend, the end of that counter trend move. So let's go over to my live charts. I'm just waiting for it to pop up on the screen. Here we go. So let's get the moving average off the chart. So what we would be looking for is first to identify the swing lows and the swing highs. So what we would do then is to go to our Fibonacci retracement tool. Where's my Fib tool? Oh, bad boy. Put it on backwards. So let's go do this again. So at this point, we would be waiting for to reach this level. At that level, we would then enter a trade to continue this downtrend. So trend, counter trend bounce. But see, we have the 50% level, which can be important. Right now, we're at the 38.20, 61.8. But this is our key is right here. We're disqualifying all this other stuff. And then we have to decide where we're going to put our stop losses and our take profit orders. Now this partly depends on the term and nature of your trend following method. A stop loss order can be placed a short distance above or below the trend line, whether it is providing by a moving average or a simple line drawn on the charts. In our opinion, the trend follower should not realize his profits until he has a good reason to do so. The purpose of the strategy is to focus on the underlying price dynamics by stripping out the volatility in short-term movements. And there is a little logic to realizing profits in response to the fluctuations, which are irrelevant in the main action of the trend. So this trading method involves a risk management component that uses three elements: volume, the current market price, and the current market volatility. An initial risk rule determines position size at the time of entry. Exactly how much to buy or sell is based on the size of the trading account and the volatility of the asset. Changes in price may lead to a gradual reduction or an increase in the initial trade. On the other hand, adverse price movements may lead to an exit of the entire trade. So price is one of the most determining factors. One of the first rules of trend following is that price is the main concern. Traders may use other indicators showing where price may go next or what it should be doing as a general rule of thumb. A trader needs only to worry about what the market is doing, not what the market might do. The current price and only the price tells you what the market is doing. Now, money management, which is another decisive factor of trend following, is not the timing of the trade or the indicator, but rather the decision of how much to trade over the course of the trend. because using the trend following strategy, once you start having a well-developed trend, you can enter at every counter trend move. Every counter trend, if it comes down to 786, you could enter a trade. If it doesn't reach 786, you let your other trade continue, but you don't enter a new trade. But if it's doing well for you, you can have several trades riding on there. Then your risk control. This means that during periods of higher market volatility, the trade size should be reduced. So trend following should be systematic. Price and time are pivotable at all times. This technique is not based on the analysis of fundamental supply and demand factors. So bearish and bullish trends are typically equal in violent and potent, whereas in the equity and forex market, price tends to statistically, when it climbs down or goes down, will come down, and you could actually measure the distance of its downward movement, and the next move up will most of the time be equal to that downward move. They tend to re-establish where they were in the prior trend, where in the stock market or equities market, we tend to see a recovery of about 50%. But this is only statistics. The simple rules presented here are good enough to replicate the performance of many large name trend following hedge funds with high precision correlation. So like I said, keep in mind position size, trend filter, and a trend filter can be a combination of moving averages. I basically use everything to simply use looking at the trend and looking for a well-developed trend. And then entry points. You could use an entry point when the price breaks above or below the moving average. So there's an old saying that goes, the trend is your friend until it ends. So keep in mind, no matter how strong that uptrend is, how well developed it is, it will end at some given point, and you should be prepared for it. So this one little line pretty much sums up the quandary that traders are faced with when trading trends. While a bias has been exhibited in the marketplace and may continue, there is no such thing as a surefire trend continuation setup. So when the trend doesn't continue, the traders often advise to look to mitigate the loss so that a reversal doesn't damage their trading account too badly. In an effort to be as precise as possible, many traders will move down to a lower time frame in an effort to get a more detailed look at the move inside the longer time frame. Price action can help traders diagnose and trade trends. Indicators, if you want to combine them, things like RSI and MACD work very well with a trend trading follow strategy. A triple moving average combination crossover can do very well. But remember, in the investment universe, trading a trend following system on a single market or only on a few different markets is suicidal. There may be long periods where there's simply no trends in any given market or asset. That's very rare. But what you're looking for this well-defined, perfectly defined trend. To find that is the key. Okay. So you can be looking at many assets. When your eyes see that that asset is exhibiting that right behavior, that non-random behavior in a well-developed trend, then you then can apply the trend trading strategy. The investment universe will choose that you choose will have a much greater impact than tweaking buy and sell rules. So choose widely. You know, for instance, if I'm trading my currencies, I trade only the euro and the euro crosses. But that gives me a large enough market to look at. But you'll see that it tends to happen that if the euro is falling or gaining and trending, all those assets tend to trend against it. So all of a sudden I'm inundated with trends. Where if the euro is not showing much, I might only have one asset showing me a trend, but it might not be well developed. So trends develop for a reason. Perhaps due to the shift in economy's fundamentals, trends show a bias that has existed on a chart. While the future is opaque and unpredictable, the bias may continue. So after all, the future is unknown and nobody has a crystal ball that will magically foretell tomorrow's price movements. But the fact of the matter is that biases do exist, and we call these trends. And well-developed trends have bigger biases. Okay, the types of strategies are endless. So I've given them to you in the handout, but let's take a look at a simple forex strategy before we move on. The simplest trend following strategy uses moving averages. The variations which can be exhibited are many. They can use 1, 2, or even 3 moving averages, which may be simple rate averages or exponential moving averages. The trading rules can be complex with different weights applied to portfolio components. However, simply by picking 3 moving averages, not randomly picking at 10, 20, 30 works well at 10, 20, 90 or 10, 30, 90. And by trading the crossovers and the spread of the moving averages, okay, will show you, or you'll learn how to interpret the trend, because when a trend is trending hard, okay, and making a well-developed trend, the moving averages will be close together. When that trend starts to diverse, the longer moving average may get fanned away from it. So always adjust for volatility. You should be always looking at market. You don't want a market that's very volatile. But put together your own trend trading strategy. Own it, keep it simple, and just get it done. Practice makes perfect. Somewhere along the line, sorry guys, I lost you somewhere along the line here. Okay, so own it, keep it simple, and get it done. So thank you very much for joining us today. Good luck with trading. And remember, there's many trend trading strategies. Ours is to use the Fibonacci tool and look for that 786. And every time it retraces 786, buy in the direction or enter a trade in the direction of that trend. And remember, risk management, money management are more important than anything else out there. So thank you very much for joining us today. And thank you for supporting Alvexo and for supporting investing.com.